My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Lyn Alden of Lyn Alden Investment Strategy. He's got a phenomenal following and has a really strong way of communicating very complex topics in easy, digestible ways. So, Lyn, for those who are not familiar with your background, talk about who you are, what got you interested in markets, and what you're currently doing with your research.
Thanks for having me. So for people that aren't familiar, my background is a blend of engineering and finance. And so I've had a lifelong interest in markets, but my initial career was electrical engineering, and then I went into engineering management and managing the finances of an engineering facility. And then eventually I transitioned into doing macro research. And the way that I do it is I apply basically systems analysis to the economy. And so similar to how I would diagnose a complex electrical system or other engineering system, I try to use similar approaches on financial systems. And that comes up with a somewhat different angle of looking at things than kind of the cookie cutter finance approach I think that's out there. And so I just do my best to provide objective, independent analysis for people. A lot of my content's free, and then I also have a low cost research service.
Let's focus on the systems analysis point you just mentioned for a second, because I'm going to make the assumption, even though it's not something I've ever done, that electrical engineering and engineering in general, there's a clear link between knowledge, effort, and outcome. Right? There's probably less variability in the errors because there's a cause and effect there. We know financial markets obviously can be quite different. It's a chaotic system where butterfly effects can be pervasive and throw any kind of thesis off. How do you think about the dynamics in terms of market behavior where there isn't a clear link necessarily as to why markets are doing what they're doing, except maybe with hindsight?
I think it's basically about isolating probabilities. And so as you point out, I do agree that basically it's a more complex system than anyone can map. There are a handful of areas such as, nutrition or climate or the economy that are just such complex systems. There's no way to fully model them compared to, human built systems that, despite being very complex, because they were built with human minds, they're, analyzable with human minds. Whereas with these more complex systems, the best we can do is map out a certain percentage of the terrain and then try to isolate kind of these if-else points. Like, if this happened, then this other thing's almost certainly likely to happen. And kind of to identify the bottlenecks and identify the pivot points of things that can happen. But it's all probability-based. It's basically, I think it takes a certain amount of humility to say, okay, here's the analysis, here's the expectation, here's what would, cause me to change that thesis, or here's what would break that assumption, and kind of go from there. So it's about having a view, like a structural view, but then also updating it, week by week, month by month, quarter by quarter, based on ongoing feedback we're getting from markets.
The term mapping the terrain is an interesting one, because I agree with you, right? You've got to be able to kind of have a macro sense to see what's happening on the ground. But the challenge, I think, with a chaotic system is the mapping doesn't necessarily tell you the roads, right? So what I mean by that is this point I keep emphasizing, that it's less about prediction and more about path, sequence of returns when it comes to actual portfolio management and money management. And I remember a study I had seen, some kind of psychology test that was done where a bunch of people were basically dropped off in a forest, and they were told, find your way out of this forest and here's a map. But they were told the map that they were given was not the map for that forest. So even though the participants in this terrain were told, here's a map that has nothing to do with the place that you're actually at, it turned out when they observed the participants that they still relied on the map because they needed to anchor onto something. So I'm saying all that because there's a natural human tendency to want to try to look to history for examples that are similar to what's happening here, just to anchor on to some kind of conclusion for how this might play out. I've heard you talk about this before, Lyn, but for the audience, talk about your macro view in terms of how things have played out, especially this year, and if there's any real corollary in history to not just the terrain, but also the roads on the terrain.
So I think if people are unfamiliar with history, I've seen, for example, a lot of pundits, a lot of policymakers, a lot of analysts calling this period unprecedented. That's a word we've heard a lot over the past couple of years. Whereas people that are familiar with financial history would consider this anything but unprecedented. It's just that the precedents, the closest precedents, are not really within our lifetimes, or at least our adult lifetimes for some of the older followers of markets. And so we have to go back essentially to the 1940s to find a similar environment. And that quote that's either accurately or inaccurately given to Mark Twain, basically the one that goes like, history doesn't repeat, but it rhymes, I think is the closest way to think about this. That there's no period in history we can say, okay, here's how it happened, and so here's how it's going to happen again. It's saying, okay, here's a period in history. What happened there? Why was it interesting? How was it similar to the current environment? How can it kind of give us some sort of outline? But then also, what are the differences between now and then? And therefore, what are the most likely areas of deviation from then? And the reason I use the 1940s is because that was essentially the last time we had, this kind of 1-2 punch of a popping private debt bubble, which was in the 1929 crash, and then into the 30s we had a collapsing private debt bubble. Interest rates hit zero for the first time in a long time, and then we started to get rising populism, and then that rising populism contributed to global war, which then resulted in a huge fiscal response. And so the 40s, after disinflation in 1930s, the 40s were very inflationary. And that money creation wasn't from bank lending. It was from fiscal spending and the central bank monetizing that spending. And so if people ask, I got the question before, if I didn't know there was a virus and I just looked at charts today, what would I think is happening? I would describe it as wartime finance. That basically, we had a similar popping of a private debt bubble in 2008, 2009. Then we had a decade of relative stagnation. It wasn't as bad, obviously, as 1930s. Different technology, different monetary policy, no Dust Bowl, obviously. There are a lot of differences. But we had this kind of stagnating period, rising populism. And then, of course, we were hit by the pandemic. We had a war-like fiscal response to it. And then now we actually have the breakout of some degree of kinetic war. And so I view the 1940s as the closest parallel. It's also the only time in U.S. history where sovereign debt as a percentage of the economy is as high as it is now. And so we saw a very different response to that inflation from the central bank compared to what we saw in the 70s. And so overall, I think that's the closest environment. There are some differences, though. So, for example, back then, the United States was kind of in China's position. It was this rising emerging market. We were a net exporter. And so in many ways, the United States looks more like the UK did in the 1940s, if we were to be more precise with that analogy. But then even then, of course, there are multiple technology differences, demographics differences, structural differences that make this period different. And, when people think of inflation, they often think of the 70s. And that's the one that I try to somewhat shy people away from, because in the 70s, that inflation was very much driven by bank lending and demographics. Basically, the baby boomers were entering their home buying years. And so you had a ton of building construction. You had a lot of bank lending. That's where a lot of the money supply growth is coming from. Of course, there was a fiscal overlay on top of that, the whole guns and butter program. And so that was a very inflationary environment. The one, but it was different. So they were, debt was low. They were able to raise rates to deal with it. Just a very different environment than the 40s and that we have today. The one thing I think we can really get out of the 70s, though, is the energy situation. So in the 1970s, domestic U.S. oil production peaked in 1970. After about a century of persistent growth, it peaked in 1970. And so you had that money supply growth and that demand growth combined with a very real supply constraint. And so the United States became more reliant on foreign imports, obviously. That opened us up to geopolitical risk and scarcity. And so I'm finding a similar environment today where energy is the bottleneck for a variety of reasons. But then the monetary and fiscal side looks generally more like the 40s than the 70s. And again, these roadmaps are not perfect, but I feel like, if people are unfamiliar with history and are unable to identify the similarities and differences between those periods, then they're kind of totally flying blind, and they're going to view a lot of things as unprecedented and confusing when we have examples of history that we should at least be aware of to help guide us.
Yeah, no, and I think that's fair. I think, from my perspective, when I say that what's happened before here has never happened before in history, I'm really talking more about the correlated drawdown of equities to treasuries, in particular 10-year. And I know this because I've tested this and I've got data from the Center for Research and Security Prices from Chicago. Booth goes into one of the papers that won the 2015 Founders Award. But if you were to look in the 70s, as much as everyone, when they think about stocks and bonds, keeps talking about the 70s, you would not find a sequence in the 70s where you've had that incredible correlation where stocks are drawing down just like treasuries are as yields are rising. It's hard to know in the 40s because there really is no data that goes back that far in time because there wasn't necessarily up-to-date, accurate total return way of kind of backcasting how bonds behaved back then. Now, there's another interesting aspect of this, Lyn, talking about the 40s and the 70s, which is there was a structural change in the way the monetary system worked once we got off the gold standard. And I do wonder if that factors into any of these types of analogies with the 40s, because even though everything you mentioned, of course, is unequivocally true and there are parallels there, that seems like it's a pretty big differentiator to even understand that make that terrain parallel, so to speak.
The main one that changed there was the structural trade deficit situation. So I factor that heavily into my analysis as it pertains to this current euro-dollar, petrodollar system compared to the Bretton Woods gold standard system, because now the treasury is at the heart of the global financial system rather than gold. That's the biggest difference. And so that's been a strong catalyst to force the U.S. to run these structural trade deficits and to have these, the positive flow of foreign capital into U.S. markets. And then our subsequent reliance on that engine continuing, and the harms that come from having that engine continuing, because it's not a purely one-way street. Basically, we kind of draw down our manufacturing base to some degree in order to have these stronger capital markets, which is, I think, a contributor to the rising populism that we're seeing today. Going back to the Bretton Woods system, although that was a large change, one thing I would actually argue is that the financial system changed substantially decades prior to that. And that was actually the more fundamental change. So by the time you got to the 50s and 60s, for example, even though the U.S. was officially still on this international gold standard, gold was not a constraint for bank lending. So money supply was growing dramatically, despite the fact that gold in the vaults of the Treasury was declining that whole time. They're basically banks. They never had a pile of gold that they checked and said, "Do you have enough gold before you can make this loan?" They didn't have that constraint at all. So you already had a complete separation from the whole process of money creation and gold, and that got marked to market in the 1970s, but that was already decoupled for decades leading up to then. Whereas I think the more fundamental changes happened decades earlier, when you moved from free banking to central banking and then increasingly abstracted the gold away from the whole process. So gold went from the banks to the central bank and then went from the central bank to the treasury. And it just got removed from the whole the whole money creation process, even when we were still on a gold standard. And that's part of the reason why we ultimately lost the gold standard, is because the gold was no longer a practical constraint on money creation. Even the foreign sector, foreign central banks could create dollars essentially by lending. And that's, the whole euro dollar market grew around the gold market. And so you had this increasing number of dollars and foreign claims on dollars, and those were foreign claims on gold. And eventually the United States severed that connection. And so that was just marking to market a problem that was already in place for pretty much the whole duration of the Bretton Woods system. And so I think that that's an important distinction, especially as it relates to the differences in trade deficits between the United States and the UK. Like I said before, I think the United States looks more like the UK from the 1940s than it looks like the United States from the 1940s. So it factors in that way, but I don't think it really factors too much into the monetary and fiscal policy angle.
Okay, let's talk about the money supply versus supply chain disruptions as narratives that explain inflation here, because I've done a number of these spaces, and it seems to be it's always it's because of supply chain disruptions or it's because of money supply, but it's never a discussion around the combination of the two at the same time. When you think about what's happened with this inflation, would you give more weight and more credence to the idea that the Fed created it or underinvestment in commodities created it?
So I pick a third variable. I would say majority of it was the fiscal side, but I ascribe to the view that it's a combination. And so, when I analyze 150 years of data among multiple countries, there are a couple of key things that have to happen for persistent price inflation to occur. One is that in order to get a lot of price inflation, you need a lot of money supply growth. You don't really have environments where the money supply is just totally normal and inflation is just spiking for no reason, right? So you have to have a significant amount of money supply creation, either from bank lending or from fiscal spending, basically large monetized deficits. So that's what's one important variable. But then there are periods where you have a lot of money supply growth, but then you don't get a lot of price inflation. So then it begs the question, like, so what's happening there? Clearly, money supply growth is necessary but not sufficient in order to have broad price inflation. And so the other side is the supply side. Basically, how tight is our ability to expand our natural resource consumption or our supply chain situation? And so, for example, if you look at the UK, over that 150 years of data that I mentioned, the UK was already a developed country during that time. It had already, filled up its land. It was already kind of tapping into its natural resources. And so you had a rather tight correlation between money supply growth and price inflation during that time. Whereas when you look at the United States, there were two big periods where you had a big decoupling between money supply growth and price levels. One was in the late 1800s, and that was in large part because we had this whole untapped continent, really, to expand across, abundant natural resources, abundant cheap land. We were just tapping into new forms of energy. There's a rapid expansion in technology that made things cheaper. And that, of course, impacted the rest of the world as well. And so you had that combination of technological deflation and you had natural resource deflation. And so that was able to offset a lot of the money supply growth that the United States experienced in the late 1800s. Basically, we had resource abundance. And then another period of decoupling was in the past 25 years until very recently, where we had a larger than normal decoupling between money supply growth and CPI. And I think the biggest reason for that was the very strong trend of globalization. Basically, that money supply growth was offset by stagnant wages. And those stagnant wages were in large part, geographic arbitrage. Basically, there was a large pool of untapped labor in China and former Soviet states. And that, basically 1 billion people were joining the broad capital markets globally. And so kind of like having an untapped continent of natural resources, we had this like untapped continent of labor resources that we tapped into. And that was a very disinflationary force. And so in my view, both the money supply growth and the supply side constraints are two very important variables to look at. And that includes the supply side includes natural resources, particularly oil, as kind of the master commodity. I think a big reason why a lot of deflationists and economists were blindsided by this inflation is because they're too focused on the demand side. If you were to ask them a year or two ago, what's going on with commodity capex, they probably wouldn't have been able to tell you. It wasn't a high priority for them to look at. And so I feel like that's always a key variable of inflation to be aware of. And then two is the whole globalization versus deglobalization thing. And so as, China demographics are kind of tapped out, as we enter this more, Cold War type of scenario, I think that very persistent period of globalization is behind us, where it doesn't mean we snap our fingers and globalization's done. But I think that level of disinflation is behind us now. And that now that we're kind of in this more steady state environment or even partially deglobalizing, I think money supply growth is more likely to be met by inflationary pressures.
Okay, I got a couple of directions to go based on that. So one area I didn't hear you mention is how the velocity of money plays into that, right? So velocity of money is necessary also for inflation, right? Money supply with velocity, and velocity of money peaked in 1997, collapsed obviously with COVID. And that's been sort of you can argue one of the things the Fed has been trying to push against over time by just trying to make up for the slower velocity with just more dollars in the system. What do you attribute that collapse in the velocity of money to? And is there maybe another potential, let's call it black swan type of risk, that suddenly that could pick up as inflation's already very elevated?
So you mentioned that velocity peaked, that 20-year ago period. We're actually, if you look back at a 150-year chart, velocity was way higher, a century before that, right? So we've actually been, that was kind of a local top in velocity. So we've actually been in a 150-year persistent decline in velocity. I have this chart out there that, I show velocity for 150 years, and then I show rolling 5-year CPI changes. And there's actually very little correlation between velocity and inflation. Now, there is correlation in the very short term, in the sense that if you during a year where you have a rapid decrease in velocity, as you saw, for example, in the very early 1930s, as you saw in 2020, for example, basically what you're getting is the collapsing GDP, and so you're unlikely to have significant inflation. You're most likely to actually have outright deflation in that environment, because that money is not being spent anywhere. Now, on the other hand, if you just merely have flat velocity and a sharp increase in money supply, by definition, what you're getting is a lot of nominal GDP growth, and that could be real growth. It could be inflationary growth. It's often inflationary growth, and so you can get these huge spikes in inflation even when velocity is totally flat. I mean, velocity in the 70s was not really higher than the 60s, for example. It was like, if you look at velocity from the 60s to the 70s, it was basically flat, even though inflation was obviously radically different between the two decades. And so I don't view, other than that brief correlation where collapsing velocity is deflationary, there's not very strong correlation. And there are multiple factors that can cause velocity to structurally go down. Some of that's wealth concentration. Some of that is maturing economy. There's all sorts of reasons. If you look at Japan, for example, they have lower velocity than the United States does. And so I don't really expect a huge upturn in velocity. And velocity is not really part of my thesis for inflation, other than that, like I said, there's that brief, sharp correlation during deflationary shocks. But other than that, it's not a very useful metric in my view. Now, one way that you can get higher velocity is if you have less wealth concentration, because if someone who's worth 20 million gets another $1 million, they're not going to spend it. It's just going to be in their bank account. It's just going to, it's going to be in their investments. Whereas if, you have a bunch of people with a $5,000 net worth, and you give out $1 million to a bunch of those people, like spread out, each one gets another $5,000, they're going to spend that into the economy. And so that's more inflationary on average than, say, having wealthy people get more wealth. One more factor I'd point at is that velocity, as we measure it, is about real, GDP, whereas velocity in financial markets has increased substantially. Basically, the holding period for the average stock keeps going down. Financial markets are a lot quicker than they used to be. And that's actually for a long time where we did see inflation, asset price inflation. So the part where we actually did see pretty high velocity, basically as wealthy people got wealthier and then they invested more and then they move it around faster, that's actually where we did see a substantial amount of quote unquote inflation. It wasn't in CPI, it was in asset prices. And I think now we're seeing it more in CPI. But again, overall, I just, other than those brief periods, I don't view velocity as a huge variable to focus on.
By the way, I'm glad you mentioned that point about the wealth concentration, that, the wealth gap is inherently disinflationary because of, to your very example, there's, Zuckerberg doesn't need 2 airplanes to get around, right? Whereas if you give that money out to more people, you'll have more airplanes flying because people will be traveling. But that's something that never made sense to me about the MMT, modern monetary theory argument, because I think one of the key tenets there is that deficits don't matter, and if you want to control inflation, then you simply tax it away. Well, the problem is if you have that wealth concentration, taxing it is only going to take it away from those that are not anyway benefiting it and not necessarily doing transfer payments. To me, it's always one of those strange dynamics that never made sense in practice. But let's go a little bit here to this point about the deglobalization trend. Which, yes, I agree is an inflationary force. But one of the arguments that's been made for many, many years is that technology eventually replaces labor. So is there a case to be made that the concerns over the end of labor arbitrage may be overblown because technology could fill the gap, so to speak?
I think in a long enough timeline, sure. If someone asks if I would be, what's my inflation outlook for the 2030s? I would say I don't know yet, because we have to see what technology looks like then. But I think, my emphasis is focused on the 2020s. And although technology is still a disinflationary force, that can be overridden by energy scarcity and other things like that. I mean, ultimately, that automation is also very energy intensive. And so, it's one of those things where, 5 years from now, could that kind of catch up with us? Sure, it certainly could. But I wouldn't focus on automation or technology as, something that's going to really radically change in the next year, 2 years, 3 years. It's something that's further out. And one way to think about this whole thing is that, productivity increases, basically technological disinflation represents our ability to organize, matter, energy, and labor in a better way than it was the years prior. And so for the most part, inflation should be, given, say, a constant money supply, we would expect slightly negative inflation year after year. Basically, our ability to make things cheaper, it keeps improving. You can imagine, for example, we used to have people with manual tools farming. Then we invented the tractor, so one person could do the work of 10 people, and then now we can have, hypothetically, one person overseeing a fleet of like 10 self-driving tractors, for example. Our ability to, say, provide food for the world used to take like half the world to do it, and now it takes like 1% of the world to do it. And so that's an example, and there's many like that, of these very disinflationary technological forces that operate over long periods of time. There are, however, years or decades where you have a step back in productivity. And that could be from underinvestment in natural resources, for example. Our ability to source the core ingredients to including all of our automations, but in all of our buildings, everything we interact with is impaired for one reason or another. Also, geopolitical realities. War is one of the most unproductive things in the long arc of time. We're basically spending resources to duplicate things and, break each other's stuff. That's about as unproductive as you get. And so that's a step back in productivity. And so there are these years or decades, generally these inflationary decades, kind of represent moving backwards for a handful of years in terms of our productivity. And I think anyone that goes to the store now or goes to a car dealer and they just don't have what you want, it shows that basically our current systems are less productive, really, than they were a couple of years ago. And I think that can be worked out in time. I think automation and technology is a key part of that, but it's also about commodity sourcing and geopolitical risks. And so I think that's a story for maybe later in the decade or next decade, whereas I think the story for this decade is more about those more immediate setbacks in productivity.
Yeah, no, that makes a ton of sense. Okay, I want to go back to a term you used. The velocity has been in markets, and as the way that you framed it made me make the link that perhaps a lot of the short-termism that we've seen in financial markets and the velocity pickup there because of all this phenomenal momentum that pretty much stopped, I'd argue, back in February of last year, that changed the stock market in particular from a leading indicator to a more coincident one, right? And traditional investing, traditional finance would argue that the stock market is a discounting mechanism of future cash flows, but it's hard for people to invest based on cash flows when they tend to just invest based on a chart. I'm curious, how do you think about the wealth effect here, and if the stock market perhaps is more of a disinflationary or inflationary force, than anything the Fed could do, because this reverse wealth effect, I think, is real, but obviously it's not yet filtered into slowing inflation.
So I think the wealth effect is an important variable. It is mainly a variable initially, at least, for the top 10% of the population that owns the vast majority of financial assets. So, for example, top 10% of U.S. owns something like 89% of equities in the U.S. And the other 90% they own the other 11% of equities. So when the stock market goes down 20%, 30%, the immediate impacts are really impacting about 10% of us the most. And like as we previously discussed with the topic of wealth concentration, we're not the ones doing a lot of the, say, commodity consumption. We're doing the the other types of consumption. And whereas the bottom 90% are still responsible for the majority of consumption because everybody has needs. Everybody, someone who's worth 1,000 times more than someone else doesn't consume 1,000 times more things just because they still have one body to work with. And so the wealth concentration effect, the wealth effect is real, but it takes time to trickle through because as people spend less, they also then, hire less, and then those people can spend less. And so it is this process that takes time to play out. Another thing is that, we've never really had the stock market as this big of a percentage of the economy before. It hit over 200% of the economy. And so it used to be that the economy, going up or down, or really, because the stocks would front run it, the anticipation of the economy going up or down would influence stocks. Whereas now stocks are so big that the tail can wag the dog. That, a declining stock market, a declining bond market, we're so financialized, especially in the US, but also elsewhere with certain, countries with very highly valued housing markets, that can really wag the dog in terms of economic activity. And so I do think that the Fed trying to put the brakes on asset markets is a disinflationary tool, but it's a very blunt one. And it's really, it takes time to trickle through, and it's really directly impacting, 10, 20% of the population for the most part. And it takes time to reach those other parts. And so I think the overall approach of trying to rein in demand in order to combat inflation is ultimately going to be seen as short-sighted, in the sense that, as soon as we return to a period of growth, let's say we go into a recession and then policymakers are forced to stimulate, the inflationary forces would quickly reemerge if the supply side, especially the natural resources side, remains unaddressed. So I think ultimately we only return to a period of disinflationary growth if we improve the supply side. And so some of that takes time. So I would describe this as we have a structural inflationary problem going forward, but there are transitory factors overlaid on top of that. Things like, logistics problems related to Chinese lockdowns and Russia's war. There are these things that, could end next year based on certain human decisions. But then the overall lack of capex in the natural resources sector is something that I think will take years. And that trying to rein in demand is kind of like holding a beach ball underwater, where we might be able to get prices down for periods of time, but then they're ready to pop back up as soon as we try to reinflate.
I'm glad you mentioned that distinction between the sort of 10, 20% that are impacted by markets, and everybody else, the 80, 90, depending on whatever metric you want to use. Because you're right. The asset that matters for the vast majority of Americans isn't really the value of their stocks. It's more the value of their homes. So let's talk about the housing market here for a bit, because the Fed itself in 2008 basically alludes to the idea that whenever they talk about the wealth effect, they're talking less about equities and more about real estate, more about the value of homes. And you can argue that, if you want to try to really slow down demand for commodities, you probably have to do it on the construction side at the margin, right? So there could be some interesting dynamics there. But talk about how you're viewing the housing market. I understand your thesis around it's going to be zip code and location specific, but there are arguments to be made that the entire asset class of housing, of real estate, probably is overall due for its own corrective period, because there you have this mortgage rate shock here.
I think it's in broad terms overvalued, and that it's likely to correct in terms of sideways, choppy stagnation for a period of time. But of course, as you mentioned, it'll be zip code dependent. Some zip codes will keep going up, other ones will go down. There's cyclical markets, there's more cash flow markets. And I think overall, it's likely to stagnate for a period of time. One way to quantify how big of an impact that is, so that's, as you point out, that's one area of the wealth effect that can hit the middle class pretty hard. And so, for example, if you look at the Case-Shiller index, the typical house is up like 20% in price over the past year. And then also, mortgage rates went from like 3% to like 5.5%, 5.2% or something, 5.25% over that past year. And so if you actually, if your mortgage is 20% larger and your interest rate went from 3% to 5.25%, that represents something like a 50% increase in monthly cost for that house. even though the house price itself didn't go up 50%. The actual the cost to actually buy that house with a mortgage is up significantly. The same house, and so that represents either a slowdown in activity, which we're seeing, and it also can represent for people that have to buy that house. Say they're moving and they have to buy that house. That's less money that they have discretionary to spend elsewhere on the economy, and so you can see weaker retail activity and weaker other types of discretionary activity. And so I think that squeeze on housing is a significant reason why we are entering an economic slowdown and why we might even be entering a recession at some point.
Yeah, and that's also why I have lumber and gold eyes, for whatever it's worth, because it's not my opinion, economically, and I know you've seen a lot of this work too, Lyn, housing tends to be a leading indicator of recessions because of the knock-on effects of the entire chain of activities that happens from construction to the actual home being built, and in terms of credit creation with home values, but also historically, usually when you have a massive tail risk event in equities, lumber in particular is weak in advance of that. And again, that's not my opinion. I can show that based on that 2015 Founders Award paper. Of course, there are always false signals in that, right? And that's an important thing I want to kind of talk about before bringing the audience. I always make it a point that historically, every major crash, correction, bear market is preceded by either weakness in lumber and or strength in utilities and or strength in treasuries. Oftentimes, they all kind of give the same message in advance of the conditions favoring the accident, but not every time, right? It's kind of like if A equals B, but B doesn't necessarily equal A, so to speak. When you think about your macro thesis and going back to that point about systems analysis, how do you try to adjust for periods where you might be in a false positive in terms of the variables that you're looking at? Because nothing is foolproof. No approach is ever infallible. And you've got to be able to be dynamic in a mentality. But what makes you maybe pivot your macro view to something entirely different?
So one is that I try to map things in rate of change terms rather than absolute terms. And so I'm constantly monitoring, are things getting better or worse from whatever level they're currently on. And I'm always super sensitive to false, turns. And so one thing I point out during the past economic expansion, which was over a decade long, you had 3 mini cycles within that expansion. So we can define those as rising and falling PMI cycles, purchasing managers index cycles. They were roughly these 3-year periods. And so we had these soft patches, which were kind of like near recessions. And they didn't manifest in full recessions for one reason or another. And so it's hard to outright predict a recession ahead of time, but you can say, is economic data accelerating or decelerating? And you can further break that down into, leading indicators, coincident indicators, lagging indicators, and say, in particular, you can say, what are the leading indicators telling us? Are they getting better or are they worse? And are they pointing severe or mild? And so it comes down to having this, step back, broad macro view, this framework for understanding the world, but then also, looking at these 6-12 month forward periods and say, what is the data telling us now? And then being able to adjust with that. And I think another way to deal with uncertainty is to not do these absolute portfolio changes. And so, for example, I don't rapidly change the portfolio based on what's happening in these expectations, but I do tilt the portfolio. So I'll have more of a defensive tilt. I'll have more of an aggressive tilt based on my perception of the opportunity set. And then as we, get more in one direction, I can dial that somewhat like a knob rather than this on-off switch. And so that's somewhat how I approach these inherent uncertainties in markets, is basically just constantly mapping things, see how it's developing over time, and then having kind of this inherent diversification base, which I then tilt in the direction that I think things are going, rather than go all in on that direction. So it's a great question. Yeah, I haven't studied the public perception in the UK during the the 40s and 50s as close as I have some other topics. So it's not a subject I'm very familiar with. One of the books to be aware of, I think, is Ray Dalio's Changing World Order. And I don't agree with every aspect of it, but it kind of goes into mapping by multiple metrics as quantitatively as possible some of these rising and falling economies. And so you could see, for example, multiple metrics of the UK going down in that period while the US was rising on multiple metrics and really hitting our peak really in the 40s, 50s, and 60s by some of these earlier metrics. And there are some that are, again, leading and lagging. I don't have the charts in front of me, but for example, education quality tends to be leading, and it tends to be one of the leading ones in terms of strengthening or weakening kind of global powers. Whereas the lagging one is actually the currency strength. Currencies, because there's a network effect there that built up over a long time. That's not something that turns on a dime, and so generally the reach of that global power has already fallen significantly by the time their currency starts, being shifted out in favor of another system. And so I would recommend that book. Again, there might be aspects I agree or disagree with it, but I think it's worth being familiar with if you're interested in that topic. As to how the UK public in particular felt during the 40s and 50s, that's just not one of my strong areas. So overall, basically, I'm going to be tilted towards value, towards real world things like pipelines, things like healthcare stocks that tend to do better in these more inflationary types of environments. And my overall view has been that this will be a longer term inflation, but that it won't be a straight line. I mean, even in the 40s and 70s, you had rising and falling periods of inflation. And so it's not like I think just, inflation's like this straight line up throughout the whole 2020s. I think there will be pushbacks. I think we're in the middle of an attempted pushback. So you can get these disinflationary cycles within an inflationary decade. That's kind of how my base case sees this playing out. And right now the market is pricing this as being very transitory. And so, for example, tips aside, if you look at oil futures, oil futures for 2024, 2025 are way lower priced than current oil prices. And so the market is looking at this as war related and reopening related and very transitory. And like I said before, there are some transitory overlays on this whole thing that can be, altered one way or another by human decisions. But I think that so I think the market still believes it's transitory, and I think that there's still alpha to be had by, if someone's correct, that inflation is going to be longer lasting than the markets think, and that the Fed trying to rein in demand destruction is going to be insufficient to address that, and that's going to end up, they're going to end up being forced to reverse on that at some point, with the inflationary supply side thing still somewhat unaddressed. And so my overall approach is to remain overweight, the natural resources sector, despite the fact that I do expect some violent pullbacks along the way, and to overall kind of just, focus on those more inflationary types of assets, while, using some disinflationary assets as hedges. I often like to joke that cash is the one speculative asset that I own, because it's the one thing that I own that I know for sure is going to go down in the long run, but that I own it for periods of time because I expect it to probably go up in the near term. And so I think that's how I'm approaching this, is to have an inflationary outlook, but then to be defensive at certain periods as I expect attempted pushbacks on that inflation.
This is where I want to get in on this talk around defensive assets and the disinflation hedges, as you alluded to. And that goes a bit to the prior point I mentioned, which is that what's never really happened before in history is this unrelenting correlation in the drawdown of equities to treasuries. And treasuries really are your sort of classic disinflationary hedge. Usually when you have high volatility in equities, again, not my opinion, when you look at actual price movement and yield movement in higher volatility periods, you tend to see treasuries do well. There's a flight to safety trade, and longer duration treasuries, at least for a moment in time, tend to be inverse to equities, right? They tend to make you money in those periods of time. That's not an argument for the longer term aspect of the interaction of stocks to bonds or stocks to treasury in particular, but in these fleeting moments of very high risk, treasuries historically are your safe haven, because treasuries have not acted as the risk off safe haven in this, what I would argue is anomalous period. Now, I'm saying all that because I want to get your thoughts, Lyn, on this idea that will the relationship of treasuries reassert against equities in high volatility regimes if you are in this secular inflation environment? I would argue yes, because I've looked at it in the 70s. But what are your thoughts on sort of this idea that treasuries kind of get back to being a diversifier when it has been horrendous this year?
It's a good question. I think I'd have two answers to that. One is that if you do start to get a disinflationary cycle within an inflationary decade, then I think that that relationship can reassert itself. Basically, if they're successful temporarily in causing enough demand destruction and get a recession, I wouldn't be surprised to see these mid to long term treasuries catch a bid as investors perceive them as safer than some of the more cyclical assets out there. And so I think you'll certainly have periods of time where that inverse correlation reasserts itself. But my second answer would be to zoom out and look at other markets. And for example, if you look at emerging market recessions, they often exhibit basically bonds and stocks selling off together. And that's generally because they're reliant on external capital. And that's because they often experience these sovereign debt crises that developed markets have not really experienced since the 1940s. And so I think that one aspect of this anomalous period that we're going through is that the developed world's not had debt as a percentage of GDP this high since the 40s. And the U.S. in particular, our sovereign bond markets have been very reliant on foreign purchases that have dried up. In part because the dollar is so strong, in part because of geopolitical differences. China's, kind of announced years and years ago that they were going to stop being a buyer on net, and so overall, the U.S. in particular is exhibiting emerging market-like characteristics, and that's obviously not in every way. I mean, we're not relying on external currency for one, right? So we're doing this in our own currency. So we're kind of like, if you view this as a lens of the U.S. is like an emerging market that happens to control its own currency, that makes some things less inconceivable in this environment. And so I would describe this as the first developed market sovereign debt crisis in many, many decades. And that can, of course, take different forms. I mean, you have the ECB is unable to, stop QE because you would have Southern European countries have their debt markets blow out, like Italy. Italy's been entirely reliant. There's no foreign demand for Italian bonds at these rates, and they can't, with 150% debt to GDP, they can't support very high rates. And so you've had the ECB monetizing that to try to keep spreads under control, although they can't really describe that out loud. That's why when Christine Lagarde's pressed, she always kind of defers and is unclear. Then you look at the Bank of Japan. I mean, they have 250% debt to GDP, and they're doing yield curve control, so they're pegging yields at 0.25% for the 10-year. And the United States is not doing any sort of formal yield curve control yet. And so we're having this kind of move up in yields at a faster rate than some other markets. And again, if you go back to the 40s, they did do yield curve control. So I think if they did not do yield curve control back then, you probably would have had a similar period where bonds and stocks were selling off together. Because at one point in the 40s, you had 19% year-over-year inflation, but they were just pegging the 10-year yield at 2.5% or less. And so the question, what would the 10-year have done in that environment if there was no central bank intervention? And so I think that when we look at this in the context of a structural sovereign debt problem, and we look at some examples of emerging markets, understanding their differences and their similarities, this period again is not that unprecedented, even though it's uncommon.
Yeah, no, and I will say I was tweeting that a couple of times last month that the more I look at the dollar and think about some of these macro intermarket relationships, I put that tweet out and sharing the space that I think there's a sovereign debt crisis incoming. Of course, the path and sequence is what's going to matter to get there, but I'm with you on that.
It's a good question. I think obviously the answer is we can't know for sure. My base case is to see gold probably do pretty well this decade. By most metrics, gold went into a bubble in 2011 and 2012. And so it had that massive consolidation after that. And it's been in this general uptrend since, although obviously it's run into turbulence over the past year and a half or so. But as you point out, year to date, it has held up way better than stocks and bonds. And better than you'd expect from looking at real rate correlations, things like that. So there is clearly a bid for gold. that is pretty persistent. And I think you would probably get a breakout if you were to have a perception of Fed capitulation, that basically that they've reached as tight as that they're going to be able to get, while still having inflationary pressures, just because the economy at that point is so weak. So I do think that there is a case for a gold breakout in the years ahead, and that basically we could be in what is essentially a big cup and handle pattern in the process of playing out. I also think if you zoom out, like the firm Incrementum, they're the ones that publish the annual In Gold We Trust report. It's a very good macro report, and they're kind of these big European gold bugs, but they also incorporate Bitcoin. And what they do is they have like a fund that's something like 25% gold and 25% Bitcoin, and basically it's kind of like their hard money fund, and they rebalance it whenever it gets out of whack. And so they kind of harness Bitcoin's volatility and outperformance while minimizing its downward volatility. And so if you have a basket of that, it's done pretty well, right? Because generally in these rising PMI environments, rising liquidity, Bitcoin's been a huge winner in the hard money space. I think it's taken some market share from gold. And then when you have declining PMI environments, withdrawing liquidity, that's generally gold's opportunity to either go up or at least hold up better than a number of other assets. And so a fund like that has actually done pretty well. So hard monies have done well this decade when you consider the multitude of hard monies that are out there. And I think that's probably set to continue. And I do think that we're probably going to see a gradual shift towards central bank balance sheets. They've already been increasing their gold exposure and not really increasing their treasury exposure too much in the prior years. And I think that's probably going to set to continue. And that's partly because what we saw in late February, where Europe and the United States were able to seize foreign reserves, because if you hold foreign reserves in a foreign liability, that's not a very censorship resistant asset to hold. Whereas having self-custodial gold or diversified, foreign liabilities, that's a way to reduce that single point of failure risk. And so I think that the overall sovereign case for owning gold has probably increased in recent months. When you combine that with negative real yields for most sovereign debt around the world, and still, long-term probably increasing money supplies for a lot of these developed markets, I think the case for gold's pretty strong. And I would just make sure that I wouldn't want to own gold without owning Bitcoin, because they're somewhat in competition now, and we've had this kind of, the marginal market share has shifted towards Bitcoin in the past decade. It's probably a good name for the space. Anyway, I perceive this as still being a declining PMI environment and still being in a risk-off situation. So as long as central banks are at least trying to, around the margins, tighten into what is in the data already an economic slowdown and potential recession, I think it does pay to continue to be risk-off. And I think that there are still bubbles in certain housing markets, in certain crypto markets, in certain aspects of the stock market, that I still think that there's air that has to come out of some of those balloons. On the other hand, I think that when we eventually do get central banks unable to continue tightening due to the economy being so weak, while some of the inflationary pressure is still there, you can kind of see like currency devaluation could catch up to some of these prices, right? So things can correct downward, or they can correct sideways in time. And different markets tend to do that differently. Housing markets tend to be less volatile, so they when they correct, they tend to correct sideways unless they get to truly bubble valuations like we see in some of these countries and some of these markets. A general trend I've noticed is that in the US, our equity valuations for a similar sector tend to be higher than the rest of the world. The foreign sector has been very willing to buy our equities, whereas the opposite is generally true for a lot of housing markets, at least outside of major cities. Whereas if you look at housing valuations in Canada, Australia, Europe, Southeast Asia, China, a lot of similar properties are more expensive than you'd find in the US. Basically, the US is very equity oriented, and the rest of the world is very real estate oriented. Basically, as our money's been weak around the world, we've monetized these other assets, and for cultural reasons and for market structure reasons, we've monetized different things at different degrees. And so a lot of this can be perceived as people monetizing things for lack of good money. As their money has negative real rates associated with it structurally, they go out and they store value in other things. And if you do get a period of harder money, then you do get a sharp devaluation in those other things. However, if they're unable to harden the money, then those other things can, either stay elevated or keep going up in that depreciating unit, right? So those things might go down in gold terms, but they could still go up in fiat terms if you get a persistent enough currency devaluation. And that's something you see in emerging markets. Again, going back to the whole comparison to emerging markets, where when you have recessions, inflationary recessions in those markets, sometimes you'll see their stock market and their real estate market continue to go up in their local currency terms, even as, of course, they're going down in dollar terms or gold terms, because the unit of account is what itself is being disrupted. And so I do think that there are pockets of excess that still have to come out in this market. And I still do remain risk off in general. But there are other things that I think have already been rather washed out. And I do think we're getting to a period where there are a number of things that someone can buy and own for the long term, while acknowledging that there are other pockets that are still not worth touching with a 10-foot pole.
So with that said, again, everybody, thank you for joining. Lyn, I always appreciate you being a part of these conversations, and enjoy the rest of your weekends, because if you don't enjoy life when markets are closed, which obviously doesn't include crypto, what's the point? So thank everybody for joining, and thank you, Lyn. I appreciate it. Cheers, everybody.